Good afternoon, everybody. I'm Ryan Ricci. We're going to do another reaction video to the FOMC meeting. And as always, I'm joined by our digital asset analyst, Ish.
Thanks for having me.
Of course. I mean, who better to talk about the Fed than the guy who loves Bitcoin, am I right?
The guy who hates the Fed.
Well, actually,
Not the only guy.
well, before we get into this, there was that Poly market for the first words that would come out of Powell's mouth at the presser? And which is crazy because we'll roll the clip, and I always do this thing where he says good afternoon, I say good afternoon. So I would have won.
It was good afternoon.
It was good
afternoon.
afternoon.
I would have thought that.
Yeah, but it's funny because they always say that. But anyway, we're going to get right to this. It's going to be a fun one, so let's go.
Good afternoon.
Good afternoon.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state and remains solid. Inflation has moved much closer to our 2% longer run goal. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. To that end, today, the Federal Open Market Committee decided to take another step in reducing the degree of policy restraint by lowering our policy interest rate by a 1/4 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments.
All right, we'll pause it there. All right, so it's the same thing he always says, right? Which is, it almost puts you to sleep. That's okay.
Almost.
We have slides. We'll show you what happened. So we'll go to the first slide. So all that happened was he reduced his rates by 25 basis points. So that's the Federal Reserve's rate. He reduced it by 25 basis points. Okay. In this current cycle, he has reduced the rates, the Federal Reserve's rate, by 100 basis points, which just means like 1 point. So like 5.5 minus 4.5 is 1 point. So like 1%. Yeah, there we go. Right? So that's all that has happened. That's all that really happened today. Okay? And so that's what happened. And if we go to the next slide, I think this is kind of what's also important in terms of how does like a market react to this. It's essentially like the market almost like doesn't really care at this point. It's more like the market is front running and telling him what to do. So if we look at what happened with mortgage rates, right? That's that black line. Blue line is the Federal Reserve's rate. So black line is mortgage rates. So you can see while the mortgage rates were coming down before Powell started cutting rates. Okay, then he starts cutting rates, and then the mortgage rates go up, right? Which is the exact opposite of what you would think should happen.
Right.
The reason being is everything runs on almost expectations, right? And so what we have been saying for now, maybe since we've started this, but at least for 3 months, is inflation is going to reaccelerate. And when he cuts rates, all it's going to do is increase inflation quicker and or more, and it's just going to guarantee this increase in inflation. That is what the mortgage rates are seeing. Okay, they're increasing because they believe that inflation is going to go up and that Powell can't cut forever and that he's going to eventually have to either keep rates flat or raise rates. But so it's really funny to watch that mortgage rates. Let's just say Powell just didn't do anything, right? Like he just never cut or just said we're not going to cut or anything. Your mortgage rates probably would have actually kept going down, if not stayed at a lower level than where they are today. They would not have gone up that much, because the expectation would be, okay, we are actually getting rates down a lot further and we're not going to cut. But since he cut, it's just he's basically reversed all progress that was made on inflation.
And you think mortgage rates would have kept going down, but the markets were saying like he's going to cut eventually, and then they rose, and then he cut.
Right. Exactly. Well, it's exactly what I'm saying, right? Like by saying that he's going to cut and by actually cutting and not realizing that inflation was going to accelerate, like he made rates go up.
Right.
Because people don't believe that he's going to keep cutting. The market is way smarter than he is. right? And so
Purely reactive.
and so he's reacting to something that's happened 3 months ago. The market's saying, okay, this is what's going to happen in 3 months, right? And so you have this huge disconnect of things. And so the mortgage rate people, basically people got long of mortgage rates essentially, right? And so they profited. So essentially, yeah, the whole market basically was like, okay, this is great. And he has been ignoring him, and it's caused inflation to go back up, as we have been saying. So that's that's the start of
We got
this.
the market setting our policy, basically.
Yeah, the market does almost tell Powell what to do and sets the policy.
Yep.
So what we're gonna skip now to minute 4:19.
Action, we have lowered our policy rate by a full percentage point from its peak, and our policy stance is now significantly less restrictive. We can therefore be more cautious as we consider further adjustments to our policy rate. We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks.
All right.
We'll
pause it there. So I don't know if you saw that. He's basically, we understand that if we do this and we lower rates, we could cause inflation to go up.
Yep. Knows he's treading a fine line here.
Right? And so it's just like, it kind of stinks, but it's like he knows exactly what happens when he cuts rates, but then and then later you're going to see he's going to act like he doesn't know what happens when he cuts rates. It's this weird dichotomy of like, what is going on?
Right. Because I think in the initial 2 minutes, he said two things, like the economy has been quite strong.
Economy's been strong.
And then he says inflation has come down meaningfully, but it's not where we want it to be with regards to our long-term 2% goal. And then he cuts rates anyways.
And he cuts rates, right? So if it's not where you want it to be, you shouldn't be cutting rates, especially if your economy is doing fine.
Right.
Now, if your economy is in the gutter and you're in a recession, okay, inflation is probably not going up if that's the case to begin with. Then okay, but that's just not the case.
So it's almost like there must be one of those two things that he said that he's lying about. Either the economy's not doing well, which you could probably tell us if that's the case or not, or B, like 2% isn't really the long-term goal.
I think it's more, the economy's fine. It's not in a recession. It's slowing a little bit and maybe actually might pick up in the next quarter. So economy's fine. Not a lot of cause for concern there.
Okay, that solves that.
More that I think we'll hear it a little bit later on, like how they view rates almost, and it's just weird. It's very weird. But I think also we should note that what the market was expecting going into this was to have an additional 2 cuts next year. Okay. And currently, after this meeting, they took that down to they're only expecting only 1 additional cut. So overall, what we're gonna say is just be careful. Not be careful. Inflation's probably it will continue to accelerate. Whether or not he gets that cut right now in July, unlikely.
Especially if inflation's even higher by then, right?
Exactly. Inflation should be higher, and we'll update our subs on all of that. But that's what you should expect for the next year is inflation higher. If you are the mass people, you should expect inflation higher. And Powell's going to tell you to also expect that, and that's where you should really be pissed off. But we're going to skip a little bit forward to minute 7:10. And we're just going to skip right to the questions because listening to him might. But also, I should say, while you listen to this question, right, like, we'll play the question and I'll talk.
Employment and price stability goals. Thank you, and I look forward to your questions.
Gina Smilik with the New York Times. Thank you for taking our questions. I wonder if you could talk a little bit about why officials think it's appropriate to cut rates at all in 2025 if inflation is expected to remain firm throughout the year. And what would you expect at this point the timing might look like? Would a January cut potentially be possible, or does a pause next month seem more likely?
All right, so we'll pause it here. So
It's a
I
good
think
question, right?
right, this should be the question the whole time. Why are you? And it was the question. Like almost every meeting, it's like, hey, inflation looks like it's going up. Why are we cutting? Inflation is going up. Why are we cutting? It's been the question the whole time.
Yep.
But I think also what we're gonna have to watch is everybody should know this is a prepared response that he's just about to read off of a paper. So he knew this question was coming. It's a prepared response. Notice how he stutters in the very beginning, and also notice how long the response is to this. We're gonna play the full thing. It's long. Don't fall asleep on me, but I'll be back at it. But like it is one of the longest prepared responses I've seen him do, and it makes sense.
So
because
let me start by saying why we cut today and then move to 2025. So I would say today was a closer call, but we decided it was the right call because we thought it was the best decision to foster achievement of both of our goals, maximum employment and price stability. We see the risks as two-sided, moving too slowly and needlessly undermine economic activity in the labor market, or move too quickly and needlessly undermine our progress on inflation. So we're trying to steer between those two risks. And on balance, we decided to go ahead with a further cut, and I'll give you some details on why. Downside risks to the labor market do appear to have diminished, but the labor market is now looser than pre-pandemic, and it's clearly still cooling further, so far in a gradual and orderly way. We don't think we need further cooling in the labor market to get inflation down to 2%. Job creation is now well below the level, or certainly below the level, that would hold unemployment constant. The job finding rate is low and declining, and other measures such as surveys of workers and businesses, quits, things like that, broadly show a much cooler labor market than we had in 2019. It's still quite gradually cooling. So we keep an eye on that. Inflation, we see that story as still broadly on track, and I'll tell you why. We've made a great deal of progress. 12-month core inflation, as I mentioned, through November is estimated at 2.8%, down from a high of 5.6%. 12-month inflation has actually been moving sideways as we are lapping the very low readings of late last year. Housing services inflation actually is steadily coming down now, albeit at a slower pace than we might like, but it has now come down substantially, and it is making progress slower than hoped. And we've had recent high readings from non-market services and some bumpiness for goods. So I'll just say, so remember that we coupled this decision today with the extent and timing language in the post-meeting statement that signals that we are at or near a point at which it will be appropriate to slow the pace of further adjustments. You ask about 2025. I think that the slower pace of cuts for next year really reflects both the higher inflation readings we've had this year and the expectation that inflation will be higher. You saw in the SEP that risks and uncertainty around inflation we see as higher. Nonetheless, we see ourselves as still on track to continue to cut. I think the actual cuts that we make next year will not be because of anything we wrote down today. We're going to react to data. That's just a general sense of what the committee thinks is likely to be appropriate.
All right, so I'll pause it there.
Sorry, just...
we're going to come back to this, but everybody should know, as he said, the expectation is that inflation will be higher next year. Okay, so everybody know that, like when you're at Christmas or your holidays, talk to your Aunt Josie, right? Inflation is going to be higher, and see how she reacts. I mean, but we're gonna come back to that. So I hated that answer a lot.
It started off with like a hollow nothingness, like, oh, we chose this because it was the best decision. Basically, that's what he said.
Right. So maybe I'll answer this for him. Let's see. We caused inflation. This is if I'm Pal. Okay. We caused inflation to reaccelerate and need to pause because we have to stop the bleeding. We should have never cut in the first place. I let the American people down. That's how he should have answered it. Because that's what literally happened.
It's the honest answer.
That's the honest answer of what happened. Their models are off, and they decided to cut, and that's the honest answer. But yeah, what really got me going this morning, by the way, I started watching this at like 2 a.m. this morning. It was ridiculous.
Best time to watch it.
It is the best time. You get all the unfiltered thoughts from me. But anyway, right? It's expecting inflation to be higher next week. He's telling the people there's going to be higher inflation. But by the way, we did nothing wrong. We were on a great path. It started to really reaccelerate, and we did nothing wrong. But it's going to be higher next year. It's okay. Don't worry about it. One of the biggest things that everybody's struggling with right now is the high inflation. So, like, how we can get up there and say that without taking any responsibility, accountability, or anything is bogus. And
He's saying it's going to be higher, and we're going to make it a little higher because we're going to cut now,
'Cause they-
and we're going to have another cut.
and then we're also
like,
going to cut next year.
what is going on?
And it's just going to make it go even higher, most likely. I mean, this is really bad. This is like a moments before, wherever that meme is, like moments before a disaster. This is we're getting close to it. I don't think it'll be as big of a disaster as it was back in 2020, back during the pandemic. But you be ready for this. So I think we're going to continue. Actually, I think we're going to hear the follow up.
One quick follow up. Why, I guess, would you make those cuts? Like, what would be the trigger to cut?
So we're to cut further after this point. I would say it this way: we've reduced our policy rate now by 100 basis points. We're significantly closer to neutral. At 4.3% and change, we believe policy is still meaningfully restrictive. But as for additional cuts, we're going to be looking for further progress on inflation, as well as continued strength in the labor market. And as long as the economy and the labor market are solid, we can be cautious about as we consider further cuts. And all of that is reflected, to your question, in the December SEP, which shows a median forecast of down 2 cuts next year compared to 4 in September.
So we'll pause it there. So this is why the Fed will always mess up as long as I'm alive, or at least maybe this Fed. But okay, the way that they think about rates is in this like weird bubble. They think that there's this magical neutral rate that should be over time and eventually. It's like this magical number, right? And they make up the number based on their projections, what this number should be. So let's just say that I think they think it's around right now, around 3% is their magical neutral rate. Okay.
And what do we mean by neutral?
It's the point it's the rate at which the economy is not restrictive or easing. It's not easing and it's not restricting.
Okay.
Right? So it's neutral.
But there's still inflation.
Well, we'll get to that, Theosh, all right? You're jumping the gun.
Sorry.
Here, all right? All right, so there's that magical rate. It exists. And they've defined it. They know what it is, right? What they're basically saying right now is, yeah, we were at 5.5, which is higher than this magical rate, and we're now at 4.5. But you know what? 4.5 is still above this magical rate, so we're actually still restrictive. That's their logic.
Because we're above the
because you're above this magical rate that literally doesn't exist, that they made up. Okay? And so you're just restrictive. They're completely ignoring the fact that an economy is one of the most like robust, complicated systems. Wherever you are today is a rate. And if you lower rates, well, wherever your inflation is today is going to go up from there. It's not like...
I mean, in looking at it, just this one-sided magical rate framework, it sounds like you're just considering the economy and you're leaving out the inflation part.
They're leaving out like everything.
Yeah.
It's supply and demand, however they define supply and demand, and everything else disappears. Like literally think about your econ class where you draw a supply and demand on a piece of paper, right? That's the world that they live in. They're ignoring things like money supply. They're ignoring the balance sheet. They're ignoring the flow of money. They ignore literally everything because there's this magical rate. And as long as we're above this rate, we're actually restricting the economy. And so if inflation goes up, it's not our fault because we're actually restrictive right now. And it's like...
So it's like unrestrict by whatever means necessary? Is that the plan?
I think the plan is as long as it stays above that neutral rate, which I think they believe is 3%,
Cut.
Then we're restricting and our hands are off of inflation. We have no It's not our fault.
It's not our
It's just
fault.
not our fault. I think that's literally what he's saying and what he believes, at least from what I'm seeing, which is it's just not how the economy works at all. It's really bad because, again, if you start from inflation right here at, like, let's say 2.5, and then you cut rates, inflation goes up from there because rates are lower, right? So if you started cutting at, I don't know, inflation at 1%, and you start cutting it, then inflation's at 1%, okay, and you start cutting, then inflation's going to go up from there, but then that's inflation then maybe goes to 2%. Okay, now you're within your goal. But if you start cutting too soon, it just starts going up from that level.
Yeah.
Like there is though, like, this magical number. Like,
I think like a question asked in the last meeting really summed it up. I think someone asked like, would you consider, we have this long-term 2% goal. Would you consider letting inflation run below that to give the people some time to catch up? And he's like, that's not within our policy.
right, which makes it, then it's just
So they're not concerned about the
they're
inflation.
really not. They're legitimately not concerned about it. They don't think that they have the means, almost. Like, it's just this massive disconnect where I think they're living in a small dream world that does not exist, and they're not taking any responsibility or realizing anything.
Yeah.
And the end result is the people, us, eat their mistakes, aka we eat the inflation
Quite
that
literally.
they perpetuate.
Your grocery bills go up.
Grocery bills are up 26% since the pandemic. M2 is up 38% since the pandemic. And I think CPI is up 25% since the pandemic, right? So all of that is cumulative. All of that they're not going to take responsibility for because they are magically restrictive. And so it's not their fault. You know what? I mean, that's what really got me fuming this morning.
Yeah,
It really boiled my bubbles. Anyway, we're gonna skip to minute 24:31, and we'll keep going. We have some.
By asking about your formulation for beginning rate cuts included the phrase, we need to have confidence that inflation is moving down towards our target. Given the fact that you've raised your forecast for next year, do you have confidence or are you uncertain about the path
People
of
need to hear
inflation
this.
going
So
forward?
confidence was our test for raising rates, and we made, look at the broader sweep. We've made just a great deal of progress. We're well into the twos in core inflation, and around 2.5 or even lower than that we have been for headline inflation. So I would say I'm confident that inflation has come down a great deal, and I'm confident in the story about why it's come down and why that portends well. And I'll tell you why. Again, you do see with housing services inflation, which is one that we've really worried about, it really has come down now quite steadily at a slower pace than we thought 2 years ago, but it's nonetheless steadily coming down as market rents start to equilibrate better with new leases that turn over, not new tenants, but new leases. Market rents is new leases. So that's happening. That process is ongoing pretty much as we expect. Goods inflation, which is another big piece of it, has returned right to the range where it was before the pandemic. Just for some months this year, it kind of moved up in a bumpy way because of used cars and things like that. But we think overall that should generally be in the range it was in. That leaves non-housing services, and market-based non-housing services are in good shape. It's non-market services, and those are services that are imputed rather than measured directly, and they don't. We think they don't really tell us much about the about tightness in the economy. They don't really reflect that. A good example is financial services, which is really done off of asset prices, and that's how that inflation works. So the overall picture, the story of why inflation should be coming down, is still intact. In particular, the labor market. Look at the labor market. It is cooler by so many measures now, modestly cooler than it was in 2019, a year when inflation was well under 2%.
It's not like a
So
story,
it's not a source of inflationary pressures. Not to say there aren't regional and particular professions where labor is tight. But overall, you're not getting inflationary impulses of any significance from the labor market. So what's the story? The story is still just we're unwinding from these large shocks that the economy got in 2021 and 22 in, for example, housing services, and now also in insurance in particular, where costs went up, and those are now being reflected later in housing insurance. It's real inflation, but it doesn't portend persistently high inflation. So we and most other forecasters still feel that we're on track to get down to 2%. It might take another year or two from here, but I'm confident that that's the path we're on, and our policy will do everything it can to assure that that is the case.
So I'll pause it there.
Oh man.
I mean, unbelievable. He starts off with the fact that he has made great progress.
Great progress. Incredible.
Incredible progress. It's a great story that we're telling the people. They're buying it.
Yeah.
Well, no, they're not, first off. But anyway, great progress. I mean, okay, let's start off. Inflation is cumulative. And that's the end of the story, okay? End of story. Inflation is cumulative. When inflation goes up 25%, it doesn't matter what you're up next year if it's 2%. That people still have to eat the inflation, okay? That's where all the dissatisfaction in the economy, most of it is coming from, is that fact right there, okay? The second part is all he did was stop printing money and inflation came down on a year-over-year basis, okay?
Year-over-year.
It's a year-over-year basis that came down. But guess what? When you increase your balance sheet by $2 trillion and you stop, well, then yeah, year over year it's going to go down.
It's all relative.
It's all relative.
How about like 10 year over year?
Yeah.
Then you see.
Exactly. It is absolutely ridiculous. So all that they did, you're proud of the fact that you stopped hitting the control print button on the economy, and yeah, now it's down year over year. So like, congratulations. Now we all have to eat your inflation that you created.
It's a great story. Really.
It was a good story. So like that gets me going. Then he talks about down rents. So I'm selling my my not selling, but my where I rent. Okay, we're leaving our lease. Okay, the lease is going up $500 a month.
Jeez.
I kid you not. So he's talking about down rents. I bet you if you go out there and you pull anybody, you ask, are the rents going down? They're going to be saying no.
Yeah.
But we actually have a chart on it. So you know what? Might as well put that one up. Number 5 or 4? 4. Chart number 4. So the black line looks at rent. Okay. The black bars is the CPI rent. And yes, he is right. It did come down. But there's this thing, it's called the Case-Shiller. And this leads rent by about 18 months, okay? And so what you're going to notice, and that's the blue bar, you're going to notice the blue bar starts to go up, and it starts to go up a decent amount. So what does that say? The black bar, it maybe goes down, which is the rent that they track, for 1 to 2 more months. After that, it's going to re-accelerate. So, and then the coming year, he's going to be like, oh, he can no longer say anything about rent decelerating. It's going to be accelerating, and this is a third of their CPI calculation. Is most likely going to start accelerating again.
I think, yeah, like everything he said just did not answer the guy's question. The guy was saying, like, are you confident in your forecast that inflation is going to, remain calm, it's not go up too much? And all he pointed to was saying, look, it's been coming down. It's been coming down. He didn't say what he thinks is going to happen. In fact, that's where it started with earlier in the conference. He said, yeah, we're raising our forecast. So, I mean,
it's legitimate. It's ludicrous, is what it is.
I
Right?
gotta
I also don't understand like how you can have between 2,000 to 3,000 people employed at the Fed and you can't have a confident forecast. Like,
Yeah.
is that not your job
I think,
to have a forecast?
I respect Powell a little bit for being able to get up there and say just this garbage to everybody. I don't think he's acting independently in lying, but he's like the face that has
Yeah.
to get up there and say it.
Yeah.
And he takes that duty. So
Yeah, he does that.
I don't think I could do it.
That part he does do well. Let's go next to he's talking about goods. You know what's in goods? Food, transportation, medical care.
Okay.
Go on the street and ask somebody if their medical bills are going up or down.
I don't think I'm going to hear many downs.
There's not many downs. Food, we already know it's going up. So that was a good one. And then non-housing services includes healthcare, insurance, and hotels. Again, I don't think many people are going to say that those are going down.
No, maybe year over year.
Maybe on
right?
a year-over-year basis, it's not as big as it was going up. Then he starts talking about the large shocks. Well, first off, these are let's just start off with, Powell, maybe you should just say these are the large shocks that we created from the pandemic, right? Let's have some accountability to that, right? He created these large shocks. Does not take any accountability for that. And then he finally says it's going to be inflation is going to be persistently high for the next 1 to 2 years until it finally reaches 2% year over year. So it's a ridiculous statement, okay? Just like really understand what that means. Inflation is going to go up from here and it's going to stay high above 2% for the next 1 to 2 years.
Until it gets to 2%.
Until it finally gets to 2%.
That even makes sense.
But how can the people even be able, like people are struggling right now as it is. And he's just like, it's going to go up for the next 1 to 2 years. It's like, we're going to get to our goal. Like,
brace yourself.
Like,
that's what he's saying.
And by the way, we're also going to cut rates maybe next year and perpetuate, make it even worse for you. But you know what? In 2 years, we'll have that 2% number, and it'll all be okay.
Maybe this is what he sees, like inflation's like this, 2%.
Yeah.
It sounds like that's what he's describing.
I think he's like looking, okay, it's come down, and now it's going to go back up a little bit, and then maybe it'll come back down in 2 years. But it's like you just give it time, and it'll work itself out.
It's transitory.
It's transitory, right? Exactly. So it's on. I mean that. So go. Tell that one at your holiday party, right?
I will.
I think I'm thinking Aunt Josie. I don't have an Aunt Josie, but
I don't either.
I think it's a good name. Anyway, but yeah, tell her that inflation is going to be higher for the next 1 to 2 years, and it's going to get a little bit worse, and see her reaction to that.
Well, I'll be sure to tell her it'll come down to 2% eventually.
Over time. All right, so we're going to skip to now minute 49:43. I think this is the last question, last clip here.
And just one follow-up. Let's look more long-term. You previously predicted hitting the 2% inflation target in 2026. It's now been pushed out to 2027. You said you're focused on enabling further progress on inflation. That's not necessarily progress in the right direction. Are you confident that target isn't going to move further out?
We're talking about when you're projecting the economy, 3 years out, 2 years out, you're talking about high uncertainty. Very high uncertainty. We really, at that point, it's not possible to confidently predict where the economy is going to be in 3 years. So what we're doing is we're looking at what's happening now, and we're kind of projecting that the same kinds of things are happening. So we keep a strong labor market. Housing services inflation comes down. Goods and services.
We really, you want to talk about the lack of awareness? There it is.
This is not leadership.
It's so bad.
He's just like, I don't know.
I don't. You know what? In terms of predictions, we know we're predicting it, but you know what? Guess what? Not on us. We can't predict it. We employ so many people, but we can't predict it.
Highly uncertain.
It's highly uncertain. It's like, okay, but it's 2 years out. You can't get to 2% over 2 years. 3 years.
The truth is he knows he can't.
Probably.
That's what's happening.
It's probably exactly what's happening. It's like, yeah, we have goals, but these are just goals in life.
It's just a goal. It's on paper. We're not actually going to hit it.
But hey, we wrote it down, so that's pretty
his
good.
job.
That's
write it down.
Yeah. So I just say to the people, expect higher for longer. In terms of this, so it's going to continue. That's what we're going to continue to try to help everybody risk manage this. We've done a pretty great job internally of predicting it, but really just expect a higher for longer in inflation. If he continues to say that he's going to cut rates, inflation's just going to keep going up. The only thing that will really stop this is if he basically says we're holding rates flat. We're going to hold them flat for an extended amount of time. And you know what, there's a chance we raise rates. And then what would happen is your mortgage rates, your credit card rates, all inflation, all that would start to come down. Basically, he has to flip the entire narrative on its back in order to stop this. But until he does that, we'll just keep reacting to his videos in the way we always do. So make sure to come back to us, and we'll be back at the next Fed meeting.